We are cooking. All right. Yep, we are live. There we go. Hopefully everybody's doing fantastic. Welcome back to a 2024 January edition of the Breaking Bitcoin Market Update. My name is Justin Wise, lead analyst and senior mentor at crackingcryptocurrency.com. Hopefully you guys are doing fantastic wherever you happen to be in the world and however you happen to be watching the show, whether you're watching it on YouTube, Twitch, DLive, Twitter, or Facebook. We're back. We're live. Hopefully you guys are having a fantastic start to your 2024, and we are back to break down the markets, give you our thoughts, and hopefully guide you on your cryptocurrency trading and investment journey. It's been a fantastic, 2023 was a fantastic year for crypto. So much to talk about, so much to get into and dive into and break down. I want to thank anybody who comes and joins the stream. We want to keep it nice and lighthearted. We've got a lot of alpha, got a lot of information to share with you today. I'm going to be sharing with you exactly what I'm doing, the way that I am perceiving the markets, the moves that I'm making, the changes that I'm making. And let's just get right into it, guys. We've got a lot to talk about, a lot to discuss as always as we go through this. Feel free to pop any questions or comments, concerns, sarcastic remarks, hot stock tips in the chat, and we'll get to them as we roll through this. All right, we are going to get into right here first. Just be gentle with me, guys. It's been a little bit since I've streamed, so making sure everything is just working quite right. Good to see you, Alex81. Good to see you, Boris. Good to see you guys in the chat. We're going to start off. We're going to keep it nice and simple. I want to just look at the big macro picture, and then we'll work our way down. So let's start off on the weekly, then go down to the daily, and then we'll get into the day trade that I took today. And then we'll get into our, I've got a macro outlook for you guys. I've got what's going on in crypto today, and then we're going to go into farming an upcoming airdrop, which I'm going to be currently farming, and I'll walk you through exactly how I'm doing that on the Solana network. All right. So first things first, let's just take a pause here and consider objectively what the charts are telling us, because we now have, we're in the post phase of the ETF decision. So big catalyst obviously is the Bitcoin ETFs going to get approved? Are they not going to get approved? And how can we play that? So far, what we have seen from price action is certainly a buy the rumor, sell the news event, right? We had a big, 100% plus run up into the ETF decision, followed by relatively abysmal price action following said decision. Okay. Obviously we had a nice big run up. We had a lot of volatility the day prior to the actual decision because the SEC Twitter account got hacked. So we had an immediate pump up, immediate sell off, and then prices just pretty much just went sideways. So obviously, when we get down into something like the hourly and we look at price, we could say, oh, well, we had this huge dump. Price action is abysmal. But if we zoom out and we just look at things on the weekly, we can see that we really haven't had any definitive price action whatsoever. We haven't had a breakout. We haven't had a definitive breakdown out of this weekly range that we've been consolidating in. So, again, Bitcoin obviously having a quite wide range here, but it hasn't made any definitive moves. So whichever way that you want to trade this particular situation, and of course I'm going to have my bias moving forward, which I will express to you, but whichever way you decide to trade this catalyst, and I'm emphasizing the word trade because I think it's important, because my advice to the investors is going to be the same. It's been consistent for all of 2023, and it's going to be consistent moving forward through 2024. No changes really need to be made. Throughout 2023, I was very consistent in what I was doing. I just continued to add to my Bitcoin, Ethereum, and other altcoin positions, which I have continued to do. And no changes to that are really going to happen. I think 2024 is going to be a very impressive year for cryptocurrencies. I think that we are going to achieve higher prices. I think we are going to make new all-time highs. So there's really no reason for me to do any portfolio adjustments as far as that goes. I'm not going to try to time the market here. I'm not going to try to flip my bags around. That's not what I'm going to be doing, because I haven't had a lot of success with that throughout my investing journey. And what I have had the most success in, the biggest general wins for me, have been from my passive investments, just purchasing Bitcoin, holding it through rallies, holding it through years, and then essentially distributing on the way up in bull markets. All right. Now, me personally, I've just kind of continued to roll over and hold on to my BTC or invest that into other assets, which I have taken profits on. But to simplify that, all I mean to say is that I think that we're going to experience higher prices. So, of course, the big narrative right now is going to be, are we going to be experiencing some big pullback throughout the first quarter of Q1? Or are we going to continue to pump up to say, let's say 65,000 or 50,000 or something like that? So that is different from how do we invest in BTC, or what should be our investment strategy or our investment thesis. Now we're specifically talking about something that has a time horizon on it, something that is more short term, something that is medium term, and this is going to be a trade. So whichever direction that you want to trade this is going to come down to your own discretion, and just what you are observing. Do you think the price is more than likely to break out from here? That's fine. Take long positions, buy calls. Do you think the price is likely to pull back or break down from here? Buy puts, go short. Personally, I think that it makes more sense here for us to experience more pain. There's a couple narratives. Hopefully you guys will see my point here as we continue forward. Again, you're free to disagree. But again, just very fundamentally simple, right? We have a buy the rumor, sell the news event. The ETF decision has occurred. It was positive. We would, at first analysis, you would expect that prices would break out and run from here. But I don't think that's the case. Of course, it can happen. But the reason why I think that is less likely to happen in this current environment is because you're not going to have these sovereign wealth funds. You're not going to be having these pension funds. They're not going to be the first in the door to bid up BTC, even though it's been approved and even though it's been open, and even though some of the markets are open now. I think that it's going to take a lot more, especially for things like sovereign wealth funds. They've got to have a lot of meetings. They've got to this and that. I don't think right now we have the evidence that we're going to kind of have this, oh my God, if you don't have 2% of your AUM in BTC ETFs, then you're going to get left behind. I don't think we have that kind of traction yet. I think that will take a little bit longer. So having a nice pullback here makes more sense because you have all the speculators who purchased BTC just to speculate into the ETF decision, and now they're beginning to take their profits. We're in the process of them taking their profits now. So this also aligns with my general thesis of what we would see for BTC, that we would have a big run up. I've talked about the 4-year cycle thesis many, many times, and the 4 steps of the 4-year cycle thesis are as follows. We have a bear market capitulation, which of course happened with the collapse of FTX. Then we have a big rally up into the halving event, and then we have a pullback and sell off prior to the actual halving event, and then the halving event occurs, and then we run off. So that timeline does put us exactly where we are right now. We've had this nice, beautiful run up for all of 2023. We have the catalyst out of the way. Speculators can now take profits. Longer term holders can continue to accumulate and add to their bags, which is something I'm also doing. I will continue buying BTC, whether we move up or whether we move down from here. More aggressively if we move down from here, of course. So we have this pullback moving through Q1, and then the halving occurs as we get closer to April, May. And then the halving kicks off and bull market prices start roaring, and we pretty much pump into the end of 2024. There are other fundamental macro things that influence this decision as well. The biggest one being that this is an election year, and historically BTC has performed very well in election years, as well as the markets in general. There's a lot of pressure on the markets to perform well, and for whatever reason, magically they tend to move up during election years. Imagine that. All right, I am going to be sharing some. I don't want to necessarily say dissenting opinions, but when we get into our macro outlook, we're going to be going over it. One of my daily newsletters from Alfonso, Alf, when I think he's got some of the best insights in the macro monetary policy stuff right now. And that's an area that I want to get better educated at, and hopefully take you guys along for that journey as well. So that is, that's the broad outlooks here. When we actually get in and look at the technicals, obviously we can see here on the weekly time frame that all of our major moving averages are fanning out away from each other. This is evidence of a strong trend when our moving averages are moving away from each other. And when you get this broad fanning of your moving averages, again, traders start to get a little antsy, because it is the case that a widening fan of moving averages confirms a trend, but it is also the case that violent pullbacks are going to occur most frequently in those periods when you have this wide fanning of the moving averages in general. So I think just looking at all the evidence, if we do experience a breakdown of support here in the $40,000 level, then I think more than likely we are going to end up traveling down here to the 55 EMA, potentially even maybe wicks down into the 200 simple moving average here on the weekly, for prices to stabilize essentially back down in this range. So as I said, and this is exactly what I advise the individuals in the mentoring group to do as well, if we do get a breakdown in price here over the next few months, I think this is really as far as the 4-year cycle thesis goes, this is really the last opportunity to enter into positions if you are going to enter into positions, if you want to be buying positions at a discount and not stacking as prices go up. It's really the last opportunity to pull back prior to the halving. Okay. So potential to find support here. I mean, aggressive. I mean, early entries would be beginning to DCA or enter positions starting, excuse me, at the 21 exponential moving average here on the weekly time frame. That would be about 37,240. So 37,000. A more logical place for me, a place that feels more right, is the 55 EMA here at about 32,000. And then again, with potentials to see us all the way down here in the $30,000 to $28,000 range. That's a little bit more. That's a little bit more like scary though. Peckham, good to see you. Ron Legato, thanks so much for joining and hopping on the stream, guys. Thanks so much for the background update. Yeah, man, this is the downstairs. The downstairs. I had repurposed the garage into the studio. You know, drywalled it, put up the insulation, all of the things. But unfortunately, we didn't have enough time, and it wasn't in the budget to do the attic insulation. So that's obviously where all the heat, most of the heat is escaping, anyways. And we didn't have an opportunity to run any heat out there. So even though we insulated it, it's still winter in Colorado. So, you know, it's like 0 degrees out there in the garage. And I can't work where it's that cold. You know what I'm saying? So we have repurposed the downstairs into the studio currently. Hopefully the warmer weather will see me outside, because then I can be a little bit louder. You guys know me. I like to be a little bit more boisterous with my streams. Okay. All right. As far as our technical indicators go, you guys, and this is, you know, I want to be consistent. I've mentored and taught so many people now through PTP and shown people how to build objective indicator-based trading strategies. Unfortunately, although we've seen so many successes, I want to make it as digestible and easy for those who aren't familiar with systems trading to get into systems trading or to follow what we're doing. So on stream, and of course, this is going to be a live experiment as we proceed here through 2024, but I want to use indicators that are readily accessible. And by readily accessible, I mean free and easy for everybody to use. So I'm going to be using these stock indicators. And this is a great trading strategy. This is a trading strategy that I've back tested many times. It's just a good strategy. So of course, as you guys know, we focus on higher time frame trading. We focus on catching the trend. We focus on catching the majority of the movements. And we try to concern ourselves less with intraday volatility, although we do day trade as well. And we are using right now we're using 4 indicators, but 3 below the screen indicators that are very, very helpful. The first one being TSI, True Strength Index. This is one of my favorite indicators. TSI is just so good. It's so good. It's very, very good. You can build some very good strategies around this on any time frame that you're interested in. But if we just look at the clear signals that TSI gave us, of course, TSI crossed to the positive back here in January. This was, now we had, of course, we took positions prior to this breakout candle in January. We identified the regular bullish divergence, and then we also identified the fact that we just had the FTX collapse. So we felt that there was good EV in picking up Bitcoin long positions, and that's when we got pretty aggressive with going long on BTC all the way back. Following the collapse, we took our positions in December, held them through several weeks of volatility, and then we had very nice resolution with this beautiful breakout candle. So TSI told us to go long on this weekly candle close, and then kept us in the market throughout all of this pump, had us exit the market on this down candle as prices traded back down below the 200 SMA for the first time throughout this entire pump. And then, of course, we got this nice bump and run. And of course, we got the re-entry signal here. So TSI still has us long on this market. So we actually don't have a sell signal yet from TSI. So when we talk about potentially closing positions out, we're just being tentatively early. All right. On balance, volume has, of course, confirmed this recent breakout movement to the upside. Of course, we now are in a consolidation phase. So OBV is just passively agreeing with our current long positions. Now, RSI is really where things get interesting, because throughout this entire pump on the weekly time frame, RSI did correctly call this local top before we led to about a month and a half of sell-off. And then RSI also went overbought here on this particular movement. Of course, it was such a strong move that RSI just continued to be overbought. But just on the previous weekly candle close, we finally got the cross under of the RSI leading line underneath the RSI signal line, which is a great, this was something that we used to have to custom program into all of our indicators. But now we don't have to because it is in the stock RSI, which I think is just lovely. This trigger, or this trigger line or this signal line, whatever you'd like to call it. What do they actually call it in here? They call it the RSI based moving average. Okay, that's fine. Trigger line where I'm from, but whatever. But as you'll notice, we have kind of a classic reversal signal here, which is this is when our momentum oscillator will go into overbought or oversold territory and then return back into equilibrium, back below 70% in this case. So RSI currently on the weekly time frame at 69.19. So just a little tiny bit below 70, but crossing under that signal line. So giving us that first potential early sell indication is what RSI is potentially telling us here. But again, we don't have any resolute price action. We are continuing to hold support. And so far, of course, it's only Monday, but so far this weekly candle is off to a decent start. We've retraced about 50% of the open candle body from the previous week. Of course, we haven't got anywhere near this big wick territory from last week. So that's where we're at for BTC. TSI still confirming the long, OBV non-committal at this point in time, and RSI giving an early warning signal to exit our positions. And of course, we also have this extreme fanning of the EMAs and the SMA, which of course does confirm that we are in a trend, but it is at those points in time when you have that wide divergence, that wide fanning of your moving averages, that you will get those pullbacks. Paul Bob the Builder coming in hot, fast, and hard with that $5. What's going on, my brother? He says, love you, brother. Happy to see you today. Internet has been a constant desert without you. Well, I'm so happy to hear that, man. Thank you so much for coming into the stream, brother. It is good to see. It's good to see the faces, man. It is good to see the familiar faces. I miss this. I miss streaming. I wanted to come back and I wanted to stream more consistently in 2023. I had some difficulties doing that. And I'm hoping that 2024, we can get off to a more consistent start, get the streaming schedule locked in. And because there's a lot I want to share with you guys. We've got some big changes happening as far as the cryptocurrency or the Kraken cryptocurrency community goes. It's going to take a little while here. It's going to take about 2 months, but you guys are going to be seeing a completely new website, a completely new member experience. And I want to do more for you guys. I want to have a bigger and broader community, and it starts with the streams. It's always started with the streams. So thank you guys. Thank you guys so much. And thank you, Paul, Bob the Builder, man, repping it in, dude. All right. Let's get, so we've kind of summarized the daily or the weekly. Let's get down into the daily and see what more local price action is telling us. As far as the daily goes, we do have an interesting opportunity here on the daily. If you're bullish in this range and if you're a little bit more aggressive, you can see here that ever since we broke out of this consolidation period, right? We broke above and out of the supply zone on a very convincing candle pump. We can see that price continued trading upwards in this nice channel. And I actually want to extend these. I want to extend these now to encompass current price action. There we go. Okay. We have something quite interesting here. So obviously we had very aggressive and bullish price action. Whenever you guys are trading in a trend, these three moving averages can be very helpful, can really help answer questions that otherwise, they can answer questions at a glance that you otherwise might spend hours thinking about, like, oh, what is it, a bullish trend? Like, should I buy a pullback? Like, is it, whatever. The answers to those questions, guys, like, listen, trading is not a game of for sure answers. It's not how it works. Trading is a game of risk management. It is a game of taking strategic bets when you believe that the odds are better in your favor. When you have a trending asset, when you have something that puts in some very convincing price action like this, it's very easy to be afraid to trade it. Cryptocurrency, though, you have to get very comfortable with that. Because this is how cryptocurrency typically runs. And this is actually pretty subdued. This is some pretty subdued price action. Generally, when we're trading cryptocurrency, you're going to see, again, you're going to see price action that's more in line like this. And you need to have the balls really to be able to buy on a breakout and carry that and continue to hold and carry that into the next wave of pump. This is how you can get big wins in cryptocurrency because when it's not like there's one mentality that at times has served me well in cryptocurrency. Like in general, it's been good for me to be less wary. But at the same time, one issue in my own personal trading is that sometimes I'm not as aggressive as I need to be. And so I will miss opportunities. Now, that can be a good thing if you are also missing a lot of bad opportunities. So you don't, obviously cryptocurrency, there's a million things that are vying for your attention. There's 1,000 token launches every day. There's 100 things that are pumping all the time. Like it's impossible to keep on top of everything. And if you're not catching all of these things, then you can often feel like you're doing it wrong, or that something's wrong with you, or that you're not, you're not getting the trades. Like, oh my God, all these people are making money. But the reality is, you're not privy to the full story of everything that's going on, of all these people entering these positions. Sure, everybody might be in on this trade but maybe 90% of them won't actually end up making money, and they'll end up losing money. So you have to walk this fine line between not being so eager for profits that you're susceptible to bad positioning and taking bad trades and falling for scams. But at the same time, you also need to be aggressive enough to press the green button when the moment is right. So that's only going to come with experience. It's only going to come with monitoring your trades, keeping your trading journal, and identifying that. Like, hey, could I have been more aggressive with this? What are the trades that I missed? Because that's important too. If you look at a chart and you're thinking about taking a position and you decide not to, that should go in your trading journal. And this is why it's also important to limit yourself to how many positions you can analyze per day or per week or per month. You've got to have a life on top of all of this. You need to make this trading habit and trading routine, you need to make it profitable, but you also need to make it enjoyable and sustainable. And so you can't be researching every project that comes out, because the act of researching something gives you a bit of confirmation bias, like looking into something and like reading the white paper and checking out the Discord and checking out the Telegram. If you then don't like buy it, and you do that over and over and over again, that can really burn you out, because, and it's hard to do too, on top of that. First off, it's hard to do because if you put all the effort into analyzing a project, like, now you've got some confirmation bias, like, well, I put all the work into like this project, like, and then if you don't buy and it takes off, gosh, you feel like a scrub. So anyways, okay. But anyways, BTC, proceeded up here nicely, and we had very nice, like, you can see how it's, when it pulls back, you just got to be aggressive here. You've got something that's trending. It pulls back to the green EMA, the 21 EMA. You bid it up, you buy it, right? You buy it, and then you sell on the next, selling opportunity, whether, here's a very nice system, buying pullbacks to the 21 exponential moving average and selling either, subjectively on pumps, or selling when the RSI goes overbought. This is a very nice strategy. So again, you could have capitalized here, boom, capitalized here, boom, capitalized here, boom. You could have just rebought, again, hopefully having the temerity and the forwithal to sell here, or again, maybe just getting out at a small loss. But we now have a more extensive pullback now to the 55 exponential moving average and back into this original price channel. All right. So again, I think we have something a little bit different here with this type of price action, where we kind of have this, you could call it something like a UTAD, this upthrust above, or UTAR or UTAD, upthrust above distribution. So we have something that looks pretty clear like distribution here. And then we have this upthrust above distribution. This is a Wyckoff pattern for when we're looking at what tops look like. So we have these wicks, and we have this just difference. You can just see it, right? It's one of those things. Price action is sometimes hard to, and of course I'm just human, so I'm trying to find the right words for everything. But you can just see this price action looks different from any of these like local highs. It's just different, and that's important. That's information. It's different. Why is it different? Well, I think we had more resolute selling here. All right, and of course, price also drove down farther than it had before. So on one hand, we have kind of the same viable strategy, right? Price is up, price is trending, price is above the 200, and we have this pullback opportunity to the 55 EMA. So if you're aggressive on BTC here and your fundamentals are bullish, then I do think this is a good aggressive buy opportunity, right? Price is pulled back to the 55 EMA. It's worked previously so far. This is a good strategy. BTC's trending. We just got the ETF approvals. I mean, there's a million reasons why you could convince yourself to take this trade. All right. So and I think this is a good and decent trade pretty much regardless. I'm not saying it's going to make you money because prices could just fall out the bottom here tomorrow, but I think it's certainly for the bullish, for the trending trader, for the pullback trader, this trade makes a lot of sense. Bid up to 55 EMA. And then here I would be conservative, right? Obviously we're expecting, prices have already bounced from here to resistance. Even assuming that that this was a top and we're going to have a sell off. Well, oftentimes we still get a return here. All right. So, seeing prices continue up to this point, approximately like 46,000 before a continued movement down is also very valid, right? Is also very valid. So even in the event where we have a top and we're not going to break to the upside more convincingly, I still think moving from here to 46 makes sense and it's a good trade. The way that I would do this practically is I would split take profit targets. So I would look to exit 50% of your position at that 46, 45, wherever you feel comfortable setting that take profit target. And then holding that other 50% of the position, because if we do then break out and run, then you're holding and you can exit wherever you feel comfortable, on a peak, on an R, it's whatever. The other strategy, and this is going to be personally the one I'm going to be watching for, is I am more interested. Again, my bias is leaning to the sell-off. I think that is more logical. I think that is more likely. And so I would be looking for that same, instead of a profit target area, I'm going to be looking for an entry area around the $46,000 price level. I want to see prices bounce a little bit. I want to see this respected as the local top, or as the Pico top currently. Prices get up here to about 46, and then we start this movement down to the daily 200 exponential moving average, that 34,000. I think this makes a lot of sense for prices to stabilize. If we go back to that weekly, you'll see that there's confluence there. Down here, so the daily 200 SMA is coming in at 34, pretty much the high 34,000s, all right? So almost 35. But on the weekly, we've got some nice confluence there, with that also being kind of the in-between zone between the weekly 21 and the weekly 55. And as I said, I think the weekly 55 is the most logical pullback spot here. Yeah, it's the most logical pullback spot. So, I mean, that's just two fundamental higher time frame trades on the table. I think for the bullish traders, I think that right now pullback opportunity makes a lot of sense. For me, I'm going to be watching that 36 and seeing how things go. I did take, listen, obviously I did take the day trade position. Okay. I did take the day trade position long right here. Now on the daily time frame, what are the technical indicators telling us? Obviously we have the pullback opportunity. All right. Now, we have a little bit more evidence here. Now, on the daily, TSI has clearly crossed under all the way back over here. So TSI on the daily caught this move and then had us out of the market. Got us back in a little too late to take advantage of this. Had us out of the market here. Wasn't able to really take advantage of this. Just a little too sensitive on the TSI. TSI didn't do super amazing here. I mean, it did great here, getting us into this initial pump, but not super great. We do have on balance volume continually rising, so confirming bullishness here, right? There's no divergence in on balance volume. No divergence in on balance volume. And the daily RSI, the daily RSI is not really convincing here. Yes, we do have a little bit of a pullback. Price is basically a little bit below the median here for the RSI, but we don't have an oversold opportunity. And something like that's not going to come. I mean, we would have to sell off down to about like 37 right now currently, I think, for us to get an oversold RSI. I think more than likely we have more consolidation before we actually get a decisive movement here out of BTC. All right. So here on the hourly, let's get down to the hourly. So as I said, I did end up taking a long position. I took it from the 15 though. Let me explain why. Okay. I have my intraday system on. I'm on the 15-minute time frame. Now I entered this position on this blue candle, but before this blue candle started to pump like this, so I entered right down here. And again, essentially, what do I see here when I look at the market? This is my 15-minute system, so I've got VWAP and I've got SVP on. I'm also watching volatility. This is my momentum oscillator, and then I'm watching open interest and volume. All right. So here on the lower time frames, again, I'm just seeing kind of this consolidation. Obviously, we had a big movement down into this consolidation. We have this nice drive down. All right. So we have a higher low. We have another run at resistance. We have another higher low. So I like to see that one higher low, or excuse me, lower low, higher low. So this is a change of character, higher low, confirming the continued change of character. And then we had this. We had prices come up and break through the point of control on the day. This is where the most volume has been transacted. And looking at this, obviously, we can see that as prices ran up, we had buyers bid up a lot here, and then they actually got smoked, right? So everybody who bid up this range got smoked and liquidated, and then prices came back up. All right, cool. So all of these bidders are out of the market. Nobody's looking to sell back here, so we can break through here real easily. I took the long because we're forming higher lows, and what's more likely that price runs up. I took the trade. Haven't hit my profit target yet. I have an intraday profit target of 43,712. So we'll just continue to hold the position. You can see we came up here, ran up above VWAP, 2 standard deviations, pulled back, currently finding support at 1 standard deviation of VWAP. As long as the point of control holds for the day, I'll feel good about this intraday trade. As long as the point of control holds, I'd like to see this next run up and hit this 43,712. I might look to take a short position from there. I was also considering, but I didn't. I was considering hedging this position once we broke out above 2 standard deviations of VWAP, because that's my usual intraday trading strategy. To long as long as we're in consolidation, I'm shorting anything above 2 standard deviations. Here, I just went more for the directional bid, so we'll see how that plays out for me today. So far, I feel okay about it, but again, it doesn't really matter how I feel about it. It matters blah, blah, blah. All right, that's pretty much all I've got as far as BTC and price action. I want to get into more conversation pieces now and focus pieces. So the first off, let me take a little sip. How you guys doing? What's up? Shout out in the chat. It's your daily reminder to drink more water. It's good for you. It will change your life. I'm telling you, drink more water. Okay. So the first thing we're going to go through today is we're going to take a look at the macroeconomics that will be affecting the markets as we move through 2024. So this is a weekly newsletter that I get from Alfonso Pecatiello, affectionately known as Alf. Dude's super smart. I mean, sharp as a tack, and he writes about his podcast, and his whole thing is called the Macro Compass. So I want to go through this. The title of this is The Monetary Plumbing Key to Macro in 2024. So he, like many other market, pundits, analysts, we're attempting to kind of set the stage. What are we expecting for 2024? What are the catalysts that are going to occur in 2024? We want to be prepared for these things. We want to be ahead of these things. Just like, for example, I've been recommending increasing Ethereum allocation exposure because we know that we are going to be having the narrative of Ethereum ETF and futures being very front and center here in 2024. So getting ahead of that narrative and buying the rumor now before it's news is key to success. Buying the rumor when it's a rumor is important to profit, not buying the rumor when it's become official news. You're too late. You're too late. Ju Shui, happy 2024 to you as well, my friend. Thanks for watching over there on Twitch. Okay, so this is important, and it's important to understand these things. If you guys don't worry, guys, I had ChatGPT help me out with understanding some of these macroeconomic things. So us and OpenAI are going to break down these macroeconomic things together. All right. So we start off. The Fed has been running quantitative tightening for a while, and yet there is still abundant liquidity in the financial system. So, I mean, obviously, on its head, if there's abundant liquidity in the financial system, that's good, right? Like, look, we need liquidity to buy up stocks. Come on, banks, let's go. So the Federal Reserve's bond holdings are down 1.3 trillion from their peak. And we can see on this graph The blue line is the Federal Reserve's bond holdings. All right. So we can see from 2019, pretty much throughout 2022, all it did was buy up bonds. This is how, and again, I'm not super smart. I used ChatGPT to answer to help me identify some of this. What this is money creation. All right. So the Federal Reserve Bank creates money, and they use that money to purchase bonds from the market. This injects new money into the monetary system. All right. This reduces interest rates. It makes credit more accessible. There is just more money flowing through the system. Now, for our interests and purposes, this is correlated with an increase in stock prices. This is correlated with an increase in cryptocurrency prices, because excess liquidity needs to go somewhere, and individuals who control that liquidity are going to put it into what they feel is going to give the greatest return on that money, which is generally the stock market and other risk on assets. Okay, so the Federal Reserve's bond holdings are down 1.3 trillion. You can see here, of course, though, that from 2022 throughout 2023, the Fed actually began reducing the bonds on its balance sheets, which it can do one of two ways. This is very interesting. This is the key point, which the Fed can do one of two ways. So how does the Fed reduce its balance sheet? You guys are hearing this a lot. How does it actually do that? The Fed has two main ways that it does this. One, it will sell the bond back to the open market. What's interesting about that is that you might think, well, how does that change liquidity, right? Because you got to think of it like this. The Federal Reserve, here we go. The Federal Reserve creates money, and they give that new money to, let's say, a bank who gives the Federal Reserve government bonds, for example. All right. Now, the Fed can then turn around and sell those bonds back to the open market, and the money they receive it does. It goes out of circulation. So that money just disappears from our economic machine. This is a way in which the Fed tightens the economy, quantitative tightening. They take that fresh money, that new money that they had given to the banks in exchange for the T-bill. They give the T-bill back, they take the money back, and they just wipe out the money. It just doesn't exist anymore. The other way this can occur is that those bonds that the Fed purchased, they let those bonds mature. So for those of you who are just completely don't understand how the bond market works, the federal government will, in the case of federal government bonds, will sell bonds. All right. Those bonds are IOUs. So the holder of that bond is giving money to the bond seller so that the bond seller can do something with that money right now. And at a later date, this is called the bond's maturity date, the bond seller will repay that loan essentially back to the bond holder plus interest. Now that interest is actually paid out in advance as the bond holder is holding the bond. And this is called the yield on a bond. So what happens when the Federal Reserve holds a government bond that matures? All right. Well, the federal government gives money to the bank, gives money to the Federal Reserve that it zeroes out, right? It doesn't reinvest the profits. The Federal Reserve doesn't take the money that the government pays it back for holding the bond when the bond matures. It doesn't reinvest that money. And by reinvesting, I mean buying more bonds. It just zeroes that money out. The Federal Reserve has the power to make money appear and disappear, all right? It can take money out of circulation by letting bonds mature, not reinvesting the profits, by selling bonds back to the open market and burning the cash, essentially. It's a good way to think about it. Those are the ways. They can't reach in and claw money from a bank without giving them something of value in return. All right. But what Alf is saying is that this quantitative tightening has not impacted bank reserves, aka liquidity, which are only down 0.7 trillion. So about half. So they're down, the actual bank reserves are down only about half of what the Federal Reserve's bond holdings are down here in 2024. Now he goes on to say that this ongoing money mystery has caught many off guard, and it has helped fuel several bullish narratives. The most famous one being, and of course we've heard this, I've even said this, The most famous one being that higher liquidity has supported stock markets in 2023. So this idea, there is this narrative that one of the reasons that we have had such a bullish 2023 is that there has been plenty of bank reserves and liquidity. All right. And then he goes on. So basically, he'll go on with this chart to explain how quantitative tightening works. Steps 1, the Fed doesn't reinvest maturing bonds from its QE portfolio and therefore destroys reserves, also known as liquidity. So this is exactly what I was talking about. The Fed is holding bonds that mature, and instead of taking that money and buying more bonds, which would inject more money into the monetary system, they just take that money and they delete it. It just doesn't exist anymore. Steps 3 through 5, the government needs to roll over its funding, but the Fed isn't rolling over its bond holdings. Banks now need to step up and absorb more of the newly issued securities. So this is pretty important. So if the Federal Reserve is not buying bonds, okay, Federal Reserve is the primary bond buyer for the federal government. If the Federal Reserve, when the Federal Reserve is doing quantitative easing, it is snatching up all the government bonds. It is increasing its balance sheet of bonds. And it is giving all that money, it's throwing all that new money that it's buying the bonds with into the monetary system, and it ends up in banks as bank deposits or bank reserves. When the Fed is not stepping up to buy bonds, banks have to step up instead, in their stead, and purchase those bonds. This reduces bank reserves and reduces liquidity. The money that might have gone to buying stocks, bonds, all this other stuff, stocks and shares and crypto maybe potentially, is now being used to purchase bonds, which also can have a synergistic and positive effect on the stock market and cryptocurrency markets, but just specifically they're buying government bonds. And okay, this is how quantitative tightening normally works. All right, the Federal Reserve Bank does not want to buy bonds. Banks thus have to step up and buy bonds in their stead. And this reduces liquidity in the monetary system. This dries up actual cash, raises rates, and hopefully slows down an overheated economy and brings inflation under control. He's saying that's how QT normally works, and that's what should have been going on, but that is not what's happening this time. So back in 2021, the Fed had an issue. Rates were at 0%, and there was too much money in the system. All right. Money market funds, which we will now call MMFs, were bidding up T-bills, these are treasury bonds, so much that yields were testing negative levels. And so to stabilize money market rates, the Fed proposed a friendly alternative, the reverse repo facility, the RRP, which we've heard so much about. Now, what the RRP allowed banks to do, and money market funds, MMFs, is it allowed them to park money at the Fed, and they would receive interest on that money. All right, which they did so in size, right? The reverse repo facility reached $2.5 trillion. And he says, you can think of this like pin-up liquidity stored in a corner of our financial system. So instead of our previous example, where liquidity is kind of going back and forth between liquidity is created by the Fed, injected into the banks by purchasing the bonds that they bought from the federal government, and so on and so forth. And then when they purchase those bonds back, that money's just disappeared. Or excuse me, when they sell those bonds back, the money disappears. In this case, the banks are taking all that liquidity and they're storing it in the reverse repo facility. All right. In 2023, he says money market funds unleash this pent up force. The reverse repo facility usage has dropped materially, and this wave of supportive liquidity has been thrown at markets. So here he is making the very clear correlation that what banks have done for 2023 is not buy these government bonds. Instead, they have parked their cash in the reverse repo facility to earn interest. And then throughout 2023, they took all this money that was sitting in the reverse repo facility and they threw them at the markets. And that is what has been helping to bid up prices throughout 2023. It's all this liquidity, $2.5 trillion worth from the reverse repo facility. He says this is likely to continue in 2024. So far on its face, this is bullish. All right. So far on its face, this is bullish. Yeah, and it's actually, thank you, Jushui. Yes, Arthur Hayes did write about this in his blog, and it was exactly his blog that made me want to look into what Arthur Hayes was looking into. I want to understand on the level that Arthur Hayes understands. Okay. So then he's going to go into this overly graphed explanation. But all this means is that money market funds drain down their huge reverse repo facility balances and they buy treasury bonds, T-bills with it. All right. So what's happening now is that governments have to roll over their debt and they have to issue new bonds to finance their operations. We just saw this with the government shutdowns, right? The government constantly, when we say roll over debt, what that means is the government has run out of money and they have to issue new T-bills or bonds to fund operations, to just continue paying employees and moving forward and financing war and all the things that we do. When the Fed does that, generally, when the federal government does that, generally it's the Federal Reserve Bank first at the door to finance them. Yeah, we'll buy the new bonds and finance your war efforts, whatever you want to do. Cool. Build the wall. But that's not happening throughout 2023. What's been happening is because the Fed has been engaging in quantitative tightening, it hasn't been the banks stepping up like the Fed intended, which would remove liquidity from the system and dry things up. What's been happening is that it's the money market funds that have been stepping up and buying all this newly issued debt. And so we've had our money market funds basically financing our federal government instead of our banks. So bank reserves, that's why bank reserves have only dropped half of what the reduction in the Fed's balance sheet has been. And why we've seen the reverse repo facilities get drained substantially. All right. So instead of draining liquidity out of the system, what that means specifically is reducing bank reserves. All right. Instead of draining bank reserves, what we've done is we've drained the reverse repo facility, which was created to incentivize money market funds and banks to park money here instead. So what Alf is saying is that we're running a sterilized version of quantitative tightening, that we haven't actually accomplished the job that was set forth through our quantitative tightening regime. All we've done is we've drained a reverse repo facility. In other words, the Fed is actually reducing its balance sheet, but not draining the excess liquidity, bank reserves, from the system. All right. So what happens next? So the reverse repo facility was started off at 2.5 trillion. Now we're down to $600 billion. So this sterilization mechanism can work for a little bit longer in 2024. And this is why Arthur Hayes in his blog was saying that he feels that prices can continue to run throughout the first quarter of 2024. Whereas I'm personally on the side / contrary to that, where I feel it's more likely for us to have this pullback in 2024. But again, the reason why Arthur Hayes feels that we can continue to pump moving into 2024 is because there's still $600 billion left in the reverse repo facility. So there's plenty of ammunition there to continue this dog and pony show of buying up all the newly issued debt that the federal government is producing. And then he goes into, so this is the premium. You can see these big spikes. This is the premium demanded by money market funds and banks to engage in the reverse repo facility versus just parking money at the Fed like normal, selling bonds. And you can see what he's concerned about is these two massive spikes in premium at the beginning of 2020. So here he says probably the most important thing, and then if you take away just one thing from this diatribe that I'm giving you, it will be this. He says here, claiming that the amount of reserves, aka liquidity, this is bank reserves, right, in the banking system somehow affects asset prices is outright wrong, period, right? I've heard this so many times. This is something I've actually believed myself. So claiming that the amount of reserves in the banking system somehow affects asset prices is outright wrong. Banks do not use reserves to buy stocks. And that's why the supposedly direct relationship between changes in liquidity and stock market returns doesn't exist. All right. I think this is certainly a misconception that I have had. This idea that, there's more liquidity in the banking system, so that means they'll be able to buy stocks and everything, and then my portfolio will go up. It's not how it works. Banks do not use reserves to buy stocks. They just don't. All right. So there's no linear relationship between liquidity or bank reserves and stock market returns. It just doesn't exist. But banks do use reserves to engage in repo market activities with each other, and that matters. All right. So banks will be using these reserves to engage in the reverse repo facility. All right. So as the chart above shows, the requested premium to lend money in repo markets against simply depositing at the Fed is slowly increasing. Levels aren't worrying yet, but there seems to be a trend in place. All right. So here are the 7 steps to the real monetary plumbing risk ahead for 2024. So here he's kind of outlining what could happen that would cause the stock market to stop moving up and start crashing. All right. These are big picture things, right? If the Fed continues its quantitative tightening, but the money market funds stop immunizing the negative effect on liquidity, and we actually start to see that negative effect on liquidity, and then we will see the negative stock market returns that are typically characteristic of quantitative tightening that we so far have not seen. Bank reserves take a serious hit, and banks' appetites to engage in repo markets declines. The U.S. Treasury continues to issue large amounts of bonds, which is very likely to happen. The imbalance between collateral to absorb and available liquidity grows. Repo rates steadily increase, signaling more strains in the monetary plumbing arena. Leveraged players relying on steady repo rates blow up. This is what we saw with all the bank failures, and I think this is extremely likely to happen moving forward in 2024. And of course, deleveraging. This would be very clear to see. This is where we will see drastic bank failures and prices will start stumbling. In short, the money trick that made QT look like a walk in the park in 2023 might well disappear later in 2024. And this is a very underestimated risk, which almost nobody has on their radar. So in summary, we've got some big macro stuff going on, ladies and gentlemen, some big macro stuff going on. We have basically had the money market funds, as he uses the words, kind of sterilizing and immunizing the effects that we've had from quantitative tightening. So we really haven't seen, as I said, the market declines, the sell-offs that are characteristic of quantitative tightening. So everybody's kind of been like, oh, quantitative tightening, like, this is fine. Like 2023 was fine. Like we got the worst is past behind us. Is it though? It possibly could. Obviously, when we went over these 7 steps to risk, these things may or may not happen. But so far, I'm not seeing any changes from the federal government, and I'm not seeing any changes that would imply that we're going to be seeing something different. All right. So I want to share this with you guys. This is not my area of expertise, but I think this is important to not have our blinders on and to at least start to puzzle into what is happening on the broader stage of things, lest we just confine ourselves to, is Bitcoin going up or down today? All right. Okay. So that's what we've got for yeah, and I agree with you, Shui. Arthur Hayes does cover this very well in his blog. It's a very good read. We might actually go over that in our next session, but he explains all this as well. So I'm just trying to get to the bottom of this and get my eyes on this. All right, now compliments of the daily DGen. We've got our daily market wrap up here. Macro schedule for the week ahead. Obviously, the primary markets are closed today for Martin Luther King Jr. Day. Shout outs to solving complicated issues with nonviolence. Retail sales data comes out on Wednesday. We've got the Philly Fed Manufacturing Index on Thursday. Home sales data on Friday. The MI Consumer Sentiment data also on Friday. 7 Federal Reserve members are going to be speaking this week. So again, we've got quite a few catalysts for the traditional market. Lots of potential opportunities here for our options or trading volatility this upcoming week. Getting into crypto watch list for this upcoming week. Ethereum, obviously I've spoke about this at length, and now this seems to be a narrative that's being kind of picked up by the broader market and the rest of the pundits out here. But with the spot Bitcoin ETFs now approved, attention will likely start to shift to Ethereum because its catalysts are next on the horizon. So again, I think this is very critical. This is going to be the first bull market cycle ever for me, where I will have a larger allocation in Ethereum than Bitcoin. Previously, I've always had more Bitcoin than Ethereum. This time around, I have more Ethereum than Bitcoin, not just for this particular reason. Honestly, things just kind of played out that way. But then I also did make conscious decisions as I was adjusting my portfolio to keep that more in line with what I think is going to perform better. I think Ethereum is just going to perform better than Bitcoin in this upcoming cycle. We've got, I don't think this is super important, but Metis, their decentralized sequencer testing starts tomorrow. Celestia, TIA has obviously shown a lot of strength, and we've got new airdrops for TIA stakers. A lot of them are expected in the next few months. Solana, which is honestly where I am keeping a lot of my attention and focus right now in DeFi. We have Jupiter's token launch is going to happen in just 2 weeks. So the snapshot's already been taken. If you didn't get the opportunity to farm the airdrop, it's already coming past. You just have the opportunity to speculate on the token at token launch or the token generation event. Let's see here. eGold, Multiverse X will make a big announcement on January 31st. Plus the Sirius upgrade is coming on January 16th. So potential buy the rumor, sell the news event. The one that I'm going to be talking about a little bit more, well, I was going to be talking about a little bit more today, but I'm going to end the stream here in about 5 minutes, is Camino Finance. So let's see here. Yeah, Camino Finance. I would highly recommend. Camino Finance has some fantastic articles. I was just reading about these, about how to be a more efficient market maker, about which vaults to deposit into. So for those of you who just want some more general education about how vaults work, whether single-sided, or volatile versus stable, a volatile token paired with a stable coin, or 2 volatile tokens. What's the right time to LP? When should you LP? What are the market circumstances in which you could actually make money from LPing? This is their, so you just go to Camino Finance. It's really, it's been a little aggressive. But anyways, Camino Finance, their snapshot has not been taken. They're introducing their point system this upcoming week. I think this is going to be, so for those of you who don't understand or are familiar with the point system, this is a pretty new thing in DeFi for airdrops, where when you have a tokenless project that is planning on doing an airdrop and rewarding the people who actually use their protocol, they basically just give you points every time you click a button in their protocol, right? So if you come in here and you, like Camino, you can borrow and lend and provide liquidity, all this kind of stuff. You can go long and short. So every time you come in here and just use the protocol, you're going to earn points. And then the airdrop allocation that you get is going to be based on how many points you've gotten. And this is going to become, I mean, this is just a better way to do things. I think this is going to become a staple feature of DeFi airdrops moving forward. So, and I think this is great, actually quantifying, like, what do I need to do to be rewarded to earn the airdrop? I think this is going to make life a lot easier for a lot of us. And I expect this to just be a regular feature. But I'm just starting off with Camino Finance. I literally have done 0 things on this protocol. Camino Finance just came across my radar today. But I've looked into it. I've read their Medium articles now so far. And I am going to be farming this airdrop. So, and how am I going to be farming this airdrop? I've got money on Solana, so I'm just going to be interacting with the protocol. I am going to be putting some money. I'm going to be LPing. I'm going to be, I'm just going to be using the protocol, trying to rack up as many points as I can. The point system isn't in yet, but it will be coming in next week. So I'm just going to get an early start on airdropping Camino Finance. But I do highly recommend, and again, it's app.camino, Kamino, .finance, or you can just get their Twitter like I did, Camino_finance. But yeah, they'll be launching their season 1 points next week. And then we also have a big token unlock on the Injective network. $139 million of Injective tokens are going to be unlocked on January 21st. So about in a week. So, again, typically things can be bullish leading up into the token unlock and then sell off the token unlock event, of course, because you've got a big supply incoming. So just heads up for the Injective holders out there. Obviously, Inject has been a very good performing token this year. Yeah, might have some negative price action coming in next week. All right. This is good. I wanted to read this. So I think I'm going to read this and then we'll call it a day. This is from Brent Donnelly. And this is him just kind of laying out his fundamental case for how Bitcoin plays out post ETF launch. As he said, buy the rumor, sell the fact is in progress. Leverage longs hope 40,000 will hold, and they hope big money comes in on the bid for the ETFs on Tuesday or sometime soon. So what he's saying, that's Monday, the markets are closed. So you can't actually trade the ETFs, but he's hoping that big bids come in on the Bitcoin ETF markets tomorrow. But what he says here is very important. Oops, sophisticated individual investors were already long GBTC, MicroStrategy, and other stuff like Mara and Bitcoin mining stocks, and they're flipping out of that into BITI. So yeah, there is some marginal demand for spot BTC generated here, but not enough to sustain the rally and the pump. Like I said earlier, pension funds and sovereign wealth funds, they look on with interest, but they need a lot of meetings and sign-offs before they can actually pull the trigger. So they're too slow to really be guapping up all this Bitcoin right now. That's going to continue this really powerful rally that we've seen. This creates a baton pass problem, as there is not enough immediate marginal buying for all the exit liquidity that speculative longs needed. There was a lot of people who just swapped up Bitcoin to buy the rumor, sell the news on the ETF narrative, and they're looking to actively exit the market right now, but there's not enough liquidity to maintain prices here and also fulfill all their sell orders. So there's only really one direction price can move, and that's down. So he is expecting that we break 40,000 to the downside. We get some big stop outs, big liquidations. Things stabilize around $33,000 to $36,000 as strong hands appear. Then eventually in the weeks or the months ahead, there will be the first pension fund or sovereign wealth fund that announces a huge buy, and that opens up the door for others to follow. And then the risk for all these sovereign wealth funds and pension funds will shift from like, oh, I don't know, to I'm going to be left behind if I don't put on 2% of AUM. So I like this little timeline that he lays out. He's like 48, 42, you are here. Next is going to be 35, 36, and then 65. All right. And this is just, this is just so like, I don't want confirmation bias, but this dude is like literally saying what my thesis is. Of course he points out here that there could be some tiny chance. He says some really fancy words here. Crazy topside convexity, a la short squeeze if too many pensions get interested at once. Now that BlackRock has given the stamp of approval and liquidity they need. But, yeah, again, for me, that is a possibility, that we do continue to run here. And that is if enough people pile in at the door at once, but I think that, again, we both agree that that's less likely to happen. Best strategy, I think, is to wait for 36,000 and then sell put spreads to buy calls. All right. So that's just pretty classic, easy trading. All right. So again, you could capitalize on that right now by getting some put spreads, sitting tight until 36,000 and then, buying some calls, or just actually going in. Yeah, Jushui just needs to be tweaked so auto mouse click bots can't game the system. Yeah, exactly. I guess that's about it. That's about it. I agree with that. I think that is very logical. I think that is a good way to go. All right, guys, we're going to wind down. I want to thank you guys so much for joining me for another Breaking Bitcoin Market Update. It's been a pleasure having you guys in here. Thank you so much for your thoughts, your ideas. Always appreciate your support. If you want to support the channel, what we do here on YouTube, if you're not subscribed, only about half the people who watch the show are subscribed. So subscribing really helps the channel out. Smashing the like button helps. It does help get the video out there. It really helps more than you know. Comment down below what you would like to see in tomorrow's episode, and I will do my best to find some material on that you guys find interesting and engaging. We are much more than a show, though. If you guys are interested in improving your cryptocurrency trading, investment, or trading, I highly recommend joining us in the group. We've got a lot of free courses. We've got a lot of free material. We have paid material. We have paid courses, indicators, advice, much more. Check out the website. Find something that works for you. Links down in the description to everything you could possibly need in life. And you can come copy trade me on Fairdesk, earn up to $100,000 for your deposit bonus, and come day trade with me. We're having pretty decent success over there. So, all right, guys, I will hopefully see you guys tomorrow. I am going to be kind to myself, and I'm going to do my best to hold this streaming schedule, but just getting into the markets, giving you guys my ideas, my thoughts. This is very important for us to continue moving forward. So I thank you guys for all your support, and I'm sorry for the long absence. I hope to see much more of you, and I hope you see much more of me as we move forward into 2024 and crush it, guys. All right. Thank you so much. I'll see you guys next time on Breaking Bitcoin.